Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Today I've got Derek Myron running the show. And Derek, you've got a guest on the show today, right?
Rick Calderon, Managing Director at MAS Advisors LLC.
Right on. All right. Why did you bring him on the show?
Rick specializes in a particular area of planning that we find to be very, very crucial to our high net worth families. And so with that, Rick, welcome.
Well, thanks so much for having me.
Yeah, I'm very excited to have you on the show. Why don't you tell us a little bit about your firm and your background, and then we'll get into our topic today.
Sure. So my firm is specializing in tax-efficient investing. I particularly spend time on private placement life insurance. I design and implement investment accounts. I administer what we call insurance-dedicated funds, and I serve the high net worth, ultra-high net worth, their trusts, the family offices. My background is I'm a lawyer. I received my degree at University of Pennsylvania, undergraduate degree at Binghamton University, which is part of New York's SUNY system. And I started my career in the mid-'80s with a law firm called Hale & Dorr, which is now known as Wilmer Hale. So I'm dating myself a little bit here. But I've held a lot of senior legal, compliance, and business roles at two big major diversified financial services firms, Massachusetts Mutual Life and Hartford Life. I left MAS about 11 years ago, at which time I was a senior managing director, chief operating officer, and chief risk officer for the international operations. I founded MAS about, now 7 years ago. And again, we specialize in all alternative assets and tax efficiency, and we work extensively with the high net worth family offices and other advisors.
So what was the impetus that led you to leave the big, cushy insurance company positions to go found a registered investment advisor catering to the ultra-high net worth, specifically around private placement life insurance?
Yeah, I left after the capital markets started to collapse in 2009, and the amount of capital necessary to run international operations was not what it had been before. There was a contraction overall, but my experience in the years that I had been there always led me to find interesting investment solutions to problems. And I took that with me and brought it to the business that I run now.
Fantastic. So can you describe for me and the audience, who is the ideal client who should consider private placement life insurance? What are the facts and profiles of the ideal client that should consider private placement life insurance?
Well, by way of answering that, I think the first thing to understand is that PPLI is really a low-cost, institutionally priced insurance product with low fees, no surrender charges, the ability of owners to access a wide range of qualified investment options that are not available in the retail market. So the right customer is someone that wants to achieve tax efficiency, wants to do it in a smart way, values the insurance component of it, and is an accredited investor and often a qualified purchaser.
Okay. And a qualified purchaser, the definition of that is?
Somebody with $5 million in assets to invest. And often these are not individuals, they're trusts. Almost always, nearly 100% of our clients are trusts when we get involved with advising on private placement life insurance. And so we're speaking about family offices and their clients often.
Okay. So I understand you're describing two needs. It's on the one hand is the family who wants to get efficiency on certain investments, and I gather that you're talking about tax efficiency because of the inside buildup inside of a life insurance policy. you don't pay income tax as investments turn over and generate capital gains or ordinary income. It shields that investor from incurring that taxable event. On the other hand, I hear you spoke about death benefits. Perhaps the investor values at the end of the day that this investor, the cash that's in this life insurance policy, they're going to receive a death benefit, which again is not taxable, income taxable. Can you tell us the facts and circumstances of kind of just talk about the history of the market, how long it's been around, who are the players, kind of give us a little history on the market?
Sure. PPLI has been around for over 3 decades. My own exposure commenced around 1990 in what was called the corporate-owned life insurance space, and then I moved quickly into the individual ultra-high net worth space. From a regulatory perspective, PPLI is just variable life insurance. It's not a special part of the tax code. It is not provided with any special benefits. It's the Internal Revenue Code sections 101, 7702, and 817. What makes PPLI special is that low-cost structure and the ability to invest in alternative asset classes, at institutionally priced asset classes, I might mention, that you don't find in retail offerings. The market size is difficult to estimate because there's no specific breakout for PPLI. It is part of variable life sales, but estimates really range into the tens of billions of assets under management. And I know the market is active. I've been part of it for quite some time, since the early 90s. And so it's a significantly large market, and it's currently being served by U.S. firms like Zurich, which is a large multinational, Lombard, which is part of the Blackstone family, Prudential, which is certainly a household name, smaller players, and one we work with and like quite a bit is Investors Preferred Life. And there are many, many specialty firms that are offshore that have lower cost and often offer you greater policy design. So that's kind of the background on who those players are in that space. And this is all supported by really large asset management firms. So household names like MFS, AllianceBernstein, Goldman Sachs, Morgan Stanley, BlackRock, PIMCO, Legg Mason, the list goes on and on. They all have large funds that they manage and make available to these investors. So we utilize a lot of those vehicles.
So is it fair to say that those firms, Prudential, all those different life insurance companies that you mentioned, I've often heard that they've got retail offerings, and then they kind of dub the PPLI offering as the wholesale offering, where the margins are less, and they offer these products, but it's not their core line of business. Is that accurate for those insurance carriers?
For some of them, it's not. For others, it is. For Lombard, for instance, it is part of their core offerings. But you're absolutely right that this is not retail insurance. It doesn't come with high commissions. The fee structure is one that's designed for accredited investors who are very price sensitive. And since there's no commission structure, there's no costs that are incurred by a client who wants to surrender their contract. There's no fee associated with that. There aren't a lot of bells and whistles like you find in retail contracts. And so it's really a smart way of playing in this space. But some of the larger companies, this is a niche play for them. That's part of a large diversified group of businesses they have. So Prudential and Zurich certainly fit into that category. But there are plenty of players in this space that are dedicated solely just to PPLI.
Okay. Can you walk us through the mechanics of a sample transaction? Give us some facts and circumstances and just kind of walk us through the mechanics.
Yeah, so nearly all discussions about PPLI commence with understanding what the investment universe is. And while I've mentioned plenty of big household names that participate in this, there's also a lot of what we call insurance-dedicated fund vehicles, typically private funds that are unregistered. And there's some very large private credit funds, hedge funds that we like in that space. So I'd be remiss if I didn't mention funds like Golub Capital, Millennium Global Estate, two of our favorites, really perform exceedingly well and give you less volatility than you'd find if you participated in the markets. But there are a number of other smaller firms and funds that are growing. And so that's where the discussions begin. They begin around, well, what's out there? You tell me that PPLI is great because it has more investment options, but what are those investment options? That's where we start. And then we need to understand how the PPLI contract would work when you start to hold all these various assets, and we start to get into the bit more nitty gritty. How much do you want to invest? What's your age? What's your health status? And then we start to develop financial projections based on what we know and see if it makes sense for you. And I like to say this is all about the math. There's really no emotion involved here. It's just making sure that the numbers are going to be attractive to you and that it's worthwhile. But if you're somebody who has good health and you have some liquidity in order to invest, it's something that's worthwhile exploring.
Yeah, I think that many of our clients believe that taxes are on sale today, but with what's happening with the federal government deficits and state government deficits, that they expect that tax rates will continue to increase. And the subject of private placement life insurance is becoming front and center more frequently and a solution that clients want to hear about. Are you finding the same?
I'm absolutely finding the same. There's certainly been increased interest, and that interest continues to grow. We're in a time now where tax rates are pretty good, but I don't think anyone believes we're going to be staying in these same marginal tax rates. So PPLI becomes one of those tools that's available to you to try to manage the inevitable increase in taxes in an efficient way.
Yeah, I think the power of PPLI is this compounding, this being able to defer paying taxes on these investments, and the numbers with this compound growth over 10, 15, 20 years. It's staggering how much, when you take the tax man out of the way, what the numbers look like.
I mean, you're absolutely right. And the thing with PPLI that's so frustrating a little bit for those of us involved in it is we always are asked the question, why don't I know about this? Why didn't I hear about this? And often because of the fact that it's an insurance product, people get turned off to listening to it. And since it's not commission-based, or there is a commission, but it's exceedingly low and it's optional depending on who's the salesperson providing the support, it doesn't get the amount of attention it deserves. But I see all that changing. I see the growth in the advisory channels, the growth in the family offices, estate planners, lawyers, accountants, all these various individuals are learning more and more about PPLI. They know it's out there and they know it's a tool.
Okay. So you said at minimum that the investor needs to be a qualified purchaser with assets north of $5 million. When do you see when clients are willing to put a private placement life insurance transaction in place? How much money would they need to be dedicating at a minimum to set a structure up?
Well, let's actually back up. You can actually be an accredited investor, which is much lower threshold. So if you're a qualified purchaser, it brings you access to a lot of more interesting investment options, but you can actually be an accredited investor, which is far less lower threshold. In terms of assets, you need $1 million in assets exclusive of your residence, and there's also an income test. And that income test is $300,000 if you're a married couple for the last 3 years, with the expectation that's going to continue. So you can be an accredited investor, you can participate as an accredited investor, and there are companies that are willing to take investments on a private placement variable annuity for $250,000 to $500,000 is sort of their minimums. But if you're trying to build out a private placement life insurance plan, you're really thinking about investing in excess of $1 million. And many companies expect that you're going to have $1 million. And again, to access some of the really interesting investments, being a qualified purchaser means you have to have a net worth in excess of $5 million. Doesn't mean you need $5 million. to invest. It just means that's what you need in order to qualify to get access to some of these more interesting investments. So if I had, say, $2 to $5 million net worth, and I had $1 million, $1.5 million, $2 million, that's sort of the baseline in terms of who should be thinking about it. Truth be told, we often end up with clients that have multiples of those kinds of numbers that they wish to invest. But it doesn't mean that it's not available for those with less.
Yeah, so we often run into new clients, and when we're deconstructing their cash flow and their income tax situation, and whether it be private credit or other investments that throw off ordinary income taxation, we ask, well, why aren't those investments wrapped so you can continue to defer that? And when you can always tell by their eyes, like, why hasn't anybody told me that? Back to your statement. Why are you guys paying? You're not consuming this money. Why aren't you paying taxes on these passive investments that are just throwing off this ordinary income? Getting those kind of investments into a structure where you can continue to defer taxation on those makes a whole lot of sense.
Well, Derek, that's what we find, because we work with so many clients that are looking to provide wealth transfer to Gen 2 and Gen 3, and they're just not doing it in an efficient way. And it doesn't mean you should be allocating 100% of your assets that are going to be going to Gen 2 and Gen 3 through using PPLI, but you'd be remiss if you didn't explore it and see if it made sense for you. And with it's part of a proper, complete, thoughtful estate plan.
Okay, let's jump into a case study. I know that you've shared with me that the husband that's 60 and a wife that's 50, and they have $15 million to invest, and they want to pass this wealth on to generation 2, and they don't really need the returns on this money. They really want to get this money down to the next generation, and they don't want to pay income tax. Can you share with us what that could potentially look like for this couple?
Sure. So those are great ages. Husband 60, wife 50. We would ask about their general health, and we'd probably gravitate to the wife, or we could do a plan where we would split it between the husband and wife. But because the wife is younger, the cost will be less. The ability to defer more will be greater. And so for somebody like that, we would offer two different possibilities. If you had 15 million and you wanted to invest it all at one time, and you were really focused on giving this to Gen 2 and Gen 3, meaning you weren't seeking to tap this money in any way during your lifetime, then we would recommend that you invest it all at once using what is commonly called a Mech structure. And that would afford you, by your life expectancy, and let's just use age 89, although truth be told, for someone who's 50 now, a woman who's 50, her life expectancy is probably going to be into the early 90s. But let's just use 89. At 89, you get a 6.3 internal rate of return, cash on cash, assuming a 7% interest return. So if you were trying to get a 7% investment return, we're telling you that you're getting only a 70 basis point drag by age 89. That's just tremendous. So in terms of numbers, if you took the same 15 million and grew it in a taxable account, that would by age 89 grow to 77 million. And if you did that in a PPLI account, that would grow to 173 million. That's a staggering 95 million in savings, just cash on cash. And if you add the additional death benefit that comes with it, that brings you up to a 105 million benefit that you get over keeping that money in a taxable account. And that's just phenomenal. And that's the kind of thing that you can do with PPLI. It's gives you those options.
So it's the power of compounding. So let me just sum up what you said. What I heard you say was for 0.7%, so 70 basis points per annum, you get two benefits. You get the power of compounding annually. As these investments turn over annually, you're not paying tax. So that was the 95 million going from 77 million to 173 million. And then in addition, upon Mrs. Passing away at 89, you're getting an additional $10 million of death benefit. And that death benefit allows all of this money to pass free of any income tax to Generation 2 and Generation 3.
That's right.
Did I get that right?
You did. And but you can do it in another way. And the other way is, well, maybe I want to tap some of this cash in the future. We're typically talking about trusts. And so maybe the trustee needs to tap some of this cash in the future. So we structure in a slightly different way. Instead of taking all the $15 million at once, we take it over 3 years. And by doing so, by age 89, instead of a 6.3% internal rate of return, we get 6.11% internal rate of return. And again, that's phenomenal. And so your taxable account would then grow versus your PPLI account, so that you'd have a 77 million tax savings. You know, that compares pretty favorably with the 95 million that you'd had if you invested it all at once. You know, not as good, but it's still pretty darn good. And when you add the death benefit on top of that, that jumps to 92 million. So that's another just phenomenal alternative, and it's just 89 basis points is what it's costing you.
And the difference between these two scenarios, scenario one is I don't need the money. This is a death benefit only. It's gonna go to Generation 2 and Generation 3. And scenario two is, well, just in case I may need to access some of this money, you've designed it this way where the fees are slightly higher. Is that accurate?
That's right. So, I mean, in terms of taxes, both a MEC and a non-MEC structure, the single premium, multiple premium, give you the ability to have tax deferral, and there's no tax recognition when transferring among investment options, and you get the death benefit tax-free to the beneficiaries. The advantage of paying it out over 3 years is you can take tax-free policy loans, and you can take withdrawal of your assets up to originally your basis. And you can also pledge the contract as collateral for other loans, something you can't do with the single pay type contract.
Can you define MEC? You've used that word. What is a MEC?
It's a modified endowment contract, and it is a form of life insurance, but not one that most people should be utilizing, just those that have a desire in terms of leaving wealth to the next generation and don't have a need to access that cash and won't have a need to access the cash that's going to be going into the contract.
Okay. So lots of fantastic ways to defer or eliminate income tax inside of a MEC. Many different ways to design it. Tell the audience what could go wrong. What have you seen go wrong? What to watch out for?
So the things that you have to be careful about in PPLI is volatility. I worry about those who want to be speculating with PPLI. It's not for speculators, and it's not for taking excessive risks. And the reason that is because it throws off all your projections. We don't like 1 year to be up 20 and the next year to be down 30 and then the next year to be up 15. It makes it very lumpy, and the projections are not good. We really like to see good risk-adjusted returns with limited volatility, which is why we're often attracted to private credit strategies, market-neutral fund strategies with absolute returns. Those things have great appeal to us.
I can understand that. You, as the investment accounts go down, the cost of the insurance, the net amount at risk could go up, and so having this stable returns to make these projections about what the costs are going to be and what your expectations as total values are going to be, that makes a lot of sense.
Yeah, and that's a traditional way of doing it. There is an alternative that you can do if you want to have a permanent strip of insurance, and that will diminish some of those risks. And again, that's not for everybody, but that's also something that is worth exploring. And we explore all these kinds of options for you in terms of risk mitigation. It may cost a little bit more up front to have that permanent strip of insurance, but it brings you a lot of benefits at the end.
Any other than volatility, what are the other things that a buyer should be aware of?
Well, there are some limitations that a prospective owner needs to be aware of, and there's something called investor control, and if you violate this investor control, you're going to invalidate the tax benefits of your contract. And essentially, what investor control is, you can't choose a specific equity security that you're looking for or a specific fund unless it's in a structure that is in a compliant qualified vehicle, like we've been talking about, these insurance dedicated fund structures. And so you can't simply say, I'd like to invest in Apple and I'd like to do it specifically through my insurance contract. You can't do that. But you can allocate to a strategy that is one that focuses on technology and high growth, and that will invariably hold securities such as Apple, but you're not picking that individual underlying security, and so that's known as investor control, and you can't do that.
Fair enough. Rick, this has been very, very valuable information. Thank you very much. Do you have any final thoughts in closing today?
Yeah, my final thoughts is I like to say that PPLI is really the most intelligent way to not just acquire insurance, but to invest tax efficiently. And I think it's part of everyone's plans that they should consider when contemplating tax efficient investing.
Fantastic. How do our listeners get a hold of you, Rick?
Well, they can send me an email at Calderon, Calderon, at MAS Advisors LLC.com. You can also ring me on my line in Miami at 786-364-3106.
Rick, thank you so much for coming on and sharing this information. Eric, why don't you take us out?
Rick, thank you so much for being a fantastic guest today. I learned a ton. As usual, Derek always brings on the best guests, so I really appreciate your time today, Rick.
Hey, thanks so much for having me.
And of course, Derek, thank you so much for arranging this and bringing him on the show. Obviously, you guys were the two smartest ones in this room, and I appreciate learning from you.
Thank you both. And you guys have a fantastic 4th of July weekend, and we'll talk to you both real soon.
Absolutely. And please, both of you stay safe. And the same goes for you, all you listeners out there. You're listening to this after the 4th of July, and hopefully you're able to start the podcast with all your fingers. So that's great. Again, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when they come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Centura Wealth Advisory, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.